Welcome everyone to the webinar. Really appreciate you taking the time to join us. I'm really excited about today's discussion on demystifying debt between seed and Series A. I have a really great panel this afternoon to take us through the topics. So joining us on the panel is Mark Baker, John Carriel, Michelle Rogers, and myself, Dara Burke. So we're just going to run through a very quick introduction of the panel. My name is Dara Burke. I'm leading the Swoop funding team here in Canada. We're an online marketplace for small business funding. We connect businesses with lending products, grants, and equity financing. So I'll turn it over to Mark, if you could maybe introduce yourself, please.
Thanks, Dara. So Mark here, VP Marketing at Timia Capital. My history starts a long time ago, was a web developer for a bunch of years, got into B2B SaaS in 2010 approximately, and was totally hooked. So been in the B2B SaaS space ever since. And now at Timia Capital, we provide non-dilutive capital to primarily B2B SaaS companies.
Thanks, Mark. John, do you want to give us a quick intro?
Yeah, sounds good. It's great to be here speaking with everybody. I lead the funding division at Boast. We offer tax credit financing to our clients in Canada. Prior to Boast, I spent 6+ years in various senior lending roles at BDC, helping entrepreneurs of all sizes, and then moved on to Lighter Capital and Flow Capital, two different venture debt firms. One was specialized in revenue-based financing, and the other one was more a traditional venture debt facility. So I've had the fortune of dealing with high growth, capital efficient companies for some time, and excited to talk about debt solutions.
Thanks, John. Michelle, you're very welcome. Would you be able to give us a quick intro?
Sure, and thank you for having me on the panel. So I'm a professionally designated accountant, CPA. Back in the day, I was a CMA, so my practice has always been in industry, primarily in tech. I started my own startup, Virtually There CFO Services, about 2 years ago, March 2020, auspicious date. And what I do is I provide support to tech startups up to seed and Series A, typically pitch decks, forecasting, as well as bookkeeping and running a clean set of books. Prior to that, I worked for a tech startup that raised about $7.5 million in US, and we grew 100% over a year and were eventually purchased by Microsoft. And before that, I was with a division which sold primarily to the government. So lots of experience in tech and software.
Great, thanks, Michelle. Well, we're looking forward to get everyone's perspective on all of the different topics we're going to get into. But before we do, we're hoping to get a read from the audience, from the attendees, with respect to where you are in your growth journey. So we're going to be talking into these individually, and we want to make the content as tailored as possible. So we're going to run a poll. It's pretty cool seeing it live. Pretty even split, which is actually fantastic. So pre-revenue making up 36% of our cohort this afternoon. We've got 27% of our attendees in the product market fit stage or the launch phase, and 36% at growth, and another 3% at that expansion or rocket ship phase. So that's great. Without further ado, let's crack into the first stage of growth. This is the conception pre-revenue stage. So this is really characterized by companies trying to test out their hypothesis, develop an MVP, establish a leadership team, and develop simplistic reporting, understanding their burn, understanding their cash runway, all of those things that are going to be important as they go out to market to raise finance. So Michelle, I'm going to turn to you first of all, because I'd love to get your perspective on clients you've worked with through the years that are at this stage of growth, and the type of advice that you're usually dispensing to them when they come to you asking you about funding advice.
Yeah, thanks, Derry. So typically this is the stage where especially if you're a first-time founder, really you're going to be bootstrapping and proving out your technology and your product market fit. So at this point in time, you're looking at providing funding from an individual, friends and family, those types of things. If you're a second-time founder, all of a sudden your options open up to you because you have a bit of a track record. So typically investors, prior investors would be interested, and you can kind of shop around for VC support. But typically they're asking for, what kind of options are available, and the government startup funding is really important. There's a lot of grants out there that are tricky to find. And so it's helpful to work with an aggregator such as yourself, or the accelerators within each region to just keep on top of the different funding options available.
Yeah, completely agree, and definitely echo that from our perspective. Staying on top of the government funding landscape is a big challenge. And certainly from our perspective, there's a huge amount of grant funding that gets left out there on the table. And there are some debt products that are available to startups that often go overlooked as well, such as the CSBFL loan program. So that kind of ties into the next question I was going to put to the group, and that is, what do people think is the most commonly overlooked funding product for businesses at this stage of growth? So maybe I'd invite a comment from Mark on that point, and John and Michelle, please feel free to chime in as well.
Thanks, Dara. Yeah, this is probably a little unexpected maybe for me, but there's a lot of new funders out there that do really well for small loans or short-term loans. I'm sure Swoop has a bunch of examples, but if you have a marketing campaign or a sales campaign that is very effective, like you've proven a strong turnaround, and you just need to, let's say, get some more money on Google Ads, et cetera. There's lots of short-term loans that you can get. If you're careful and understand the cost of capital, that could be very useful.
Just to add to that too, yeah, I mean, there are some options at this level. BDC has run a very long program in this stage. Essentially, as long as you are within a 3-to-1 debt to equity ratio, if you have a business startup where you, let's say, put 100K, they may be able to provide you with another 200K to start your business. And this is essentially at the very early stages, whether it's a tech company or not. Actually, that's a very long unsecured working capital program that BDC has had. And most particularly, tax credit lending is available to companies at this stage. We see this, we're a bit biased because that's what we do through the Boast platform, but really it is pretty fascinating for me to see, of all of the entrepreneurs that I talk with coast to coast in Canada, most companies, they still don't know that this lending facility exists, right? And the reason being is, traditionally, any kind of shred tax credit lending facilities were only available to companies that have had previous successful claims for 2 years, and also they had to be generating revenue. But I believe early last year, with the launch of our program and with a couple of other players, we completely changed that, and now companies can be completely pre-revenue, and also they don't need to have successful claim history to be able to access tax credit lending. We have facilities that go up to $2 million for companies that are essentially backed by the fact that the government is going to refund their shred credits. So I would like to highlight that option because it is one of the only non-dilutive debt options for pre-revenue companies that don't require a personal guarantee at this stage of growth.
Yeah, that's incredibly helpful for entrepreneurs, particularly in the tech space, to be aware of. And John, if I could ask you, knowing that we have a mixture of Canadian and US-based audiences, is there anything for the US-based entrepreneurs to know about from an R&D perspective, or is it largely similar?
Absolutely. So the Canadian and the US programs are quite different from each other, but they still exist. The Canadian program, as you may know, is similar to the Australian and UK programs. It's been around for 25 years. In Canada, it's one of the most important foundation of the tech ecosystem. In US, with the passing of 2015 Act, this brought up to light, and the tax credits are not as lucrative, but they are still very applicable. I mean, as long as you have been in business for less than 5 years and generating less than 5 million in revenue, you are able to apply the tax credits as a payroll tax offset credits. Essentially, it's as good as cash, right? And it is something that we offer on the US side as well. We just don't do the advances on US side of our business. That's just particularly available for Canada.
We had a question just come in, and I think it's worth addressing right off the bat. And I'll probably put it back to you, John. Sorry to pick on you again. What type of companies qualify for SR&ED facilities?
Yeah, absolutely. So any kind of company that has an R&D project that meets the criteria that are defined by CRA, and there's a great guide through our website or through the CRA's website where you have to have technological uncertainties with the projects that you are working on. But at the gist of it, the program looks for companies that are innovating, and for not all of the projects that may qualify. For example, if you are innovating something that is readily available through an open source software, then that project may not qualify because it's not necessarily solving for a problem that exists. So companies that have an R&D, research and development expenses that qualify under the project criteria are able to access these tax credits. Therefore, they can access the advanced facilities that come with it as well.
Thanks, John. Yeah, I think it's an important point on grant financing in general. Like what we often find at Swoop when we're helping businesses with grants is that we're looking for specific activities that are relatable to the grant rather than operating costs. So not just looking at standard business overheads, but looking at the investment in specific activities. And that's an important one for entrepreneurs to be cognizant of. I'm just going to move on to the next stage of growth, which we've labeled the launch and product market fit stage. So knowing that the business at this point is post-validation, they're establishing a sales process, they're gathering feedback from their early adopters and from their customer base on the product. The reporting has become more sophisticated. From a financing perspective, there's now a wider range of funding products available to them in the debt space. So I'm going to invite a comment from Michelle and then the wider panel as well on what type of products you're most commonly helping clients identify at this stage of growth versus an earlier point in their journey.
Sure. Typically, once you have your initial cohort or two of clients, then you can start shopping around for VC investment, either angel investment or VC. And the difference between engaging with a VC versus debt equity is the role of the VC, or the motivation of the VC is looking at the future state of the organization versus the non-dilutive route, which is typically they're looking at past history and trends and your ability to pay. Sometimes when you have an institutionalized VC, as an example, so that would be a VC that has deep pockets, is well known, within the funding community, then you can get a follow-on loan from a traditional bank. And they'll loan up to a third of the equity raise for fairly low rates, fairly competitive rates. And all they're looking for is ensuring that you've got a VC that's going to be able to provide enough dry powder. So that's one option. You have to understand that when you're accepting a VC into your business, you're accepting a business partner, and so there's all sorts of things that come with that in terms of you have someone who is going to weigh in on influence and strategy and potentially execution, depending on how they like to work with the companies that they invest in. Whereas if you have non-dilutive financing, then really you're still able to grow your business without giving up too much without giving up any equity. And non-dilutive is actually really helpful in terms of a bridging mechanism to equity. If you're just at a stage where you're confident in, or you have a high degree of confidence in the return on investment in terms of spend. Yep. And you just need to get to that next stage of growth before, just that you can negotiate better terms for an equity round.
Yeah, and Mark, I might bring you in on this point, because knowing the Timia Capital offering being so valuable to companies at this stage who don't want to bring in a VC, but do need to extend their cash runway, do need to bolster marketing budgets and product development budgets. Maybe you could give us a little bit of insight as to the value proposition that Timia Capital are bringing at this stage.
Yeah, thanks, Dara. So kind of what to Michelle's point at the beginning, it's about product validation. And so where Timia's strongest fit is about a flywheel. So if you can see that your company has developed a 6-month or 9-month flywheel, that you can get a return on your investment in that amount of time, then it becomes highly profitable to leverage your business and take debt. Whereas let's say if you're in a product-led growth strategy, you might not have a strong understanding of when that return on investment would come in, and maybe be more suited towards a traditional venture capital firm. Our funding aligns very, very strongly with investment in sales and marketing. So as I mentioned at the top, there's a lot of these short-term lenders. It's really not enough capital to grow a team, and where Timia and similar companies to us have a strong fit is allowing that, let's say, 6 to 12 month runway where you can actually afford to hire additional sales and marketing people, and that can operate your plan that you can see that is already working. And so you develop that flywheel. There's other ways that you can see return on investment in a short amount of time, and that's things like acquisitions. So essentially, what you need to look at this stage is how much cash flow do you need to operate your plan, and what is your runway for return on investment. And if you can do that with debt, you're going to end up in a much stronger place, because equity providers are looking for, anywhere between 2x, 10x, possibly even 100x on their money, whereas debt providers typically max out around 2x. That's what they're looking for. So in the big scheme of things, you might actually be better off taking debt. However, it's about your historical performance. It's not about future performance. So companies like ours, we look at how the company has run so far, what its current trajectory is, what their churn rates are, things like this. And so if we see that you can continue operating on that track, and we can see that there's upward momentum, then you have a lot of options on the table. And that's a very strong place to be. I just see that there's one question here in from Colin. I'm just going to jump in and answer that, if that's okay with the panelists.
Yeah, absolutely. I was just going to say, keep the interactions coming. We do have a question Q&A section at the end. If we don't get to something on a slide, we will get to it. But yeah, please pick it up, Mark.
So Colin's question is around the shifting VC markets and if it's impacting things like venture debt, and is things tightening up, et cetera. So the great question that's extremely relevant to this conversation. So there's two things I'd like to just identify in this space. So there is a venture debt. Traditional venture debt is explained as requiring a sponsor. So for example, in the US, Silicon Valley Bank, they will absolutely provide you quite a lot of capital for quite an attractive rate, as long as Silicon Valley Bank is comfortable with your VC back, your equity provider. Timia and companies like ours actually don't require a sponsor. So typically, cost capital is a little bit higher, but we can tend to be flexible and tend to invest in companies that are either totally bootstrapped, lightly capitalized, or aren't totally sophisticated yet with their board seats, et cetera. So what we see going on, not only in the venture debt space, but our space, is we do see some tightening around, let's say, multiples, and some tightening around, as Colin mentions, burn, runway, et cetera. So previously, if a company came to us and said, oh, well, I have high confidence in getting an equity round, or my equity provider will do a follow-on, previously we might have been quite confident in that and been a bit more flexible on our multiples. So providing more cash up front. On our side, not much has changed, just the clear indication from VCs that they're providing less capital and they're being a little bit more stringent. Because when a VC makes an investment, they're looking for a return, they're looking for an exit. So it might be great to get that TechCrunch headline that you've raised that money, but eventually you have to pay that back. And they've got a timeline. And so those timelines might be adjusted. And that's probably the most significant thing, is not only VCs are looking to keep their timeline, but they're trying to keep their multiples. And with the valuations coming down and with less cash going into the latest rounds, as an entrepreneur, as a founder, you need to tighten up your plan and you need to be careful, way more careful with your money. And it's one of the things that we like about bootstrappers, capital efficient entrepreneurs, is they treat any money they have like their own money, and they're very careful about what they spend it on. And they're looking at that ROI and they're looking at those timelines.
Thanks, Mark. And I suppose on the topic of good founder habits, I'm interested to know from the panel, from a housekeeping perspective, what are the good things to have in place before applying for debt, and what are the things that founders need to be aware of? And I'll open it to the floor in case anybody wants to jump in first.
Sure, I can jump in. I would say that applying for debt on any stage of a company, having an organized data room helps a lot. Going through applications with multiple lenders, there's this notion that you have to have a specific data room to the specific lender, but I really don't agree with that approach. What I find that with most debt providers, they are looking for same models and same documentation, trailing 24-month P&L, balance sheet, cash flow statements with an extended version of that into the future to 2 to 3 years. There may be questions that come up during the application process that what I see companies do, they record these questions in terms of a Word document and include it in their data room, so that once a due diligence person or an analyst or an underwriter goes through the folder, they can actually have most of their questions answered. I would say that, and Google, Dropbox, any of these platforms work well. Another thing that I would like to mention is essentially having 2 data rooms. What I've seen companies do, they have one light data room just to start a conversation with some of the lenders, and then another data room that has all of the intimate information, articles of incorporation, the sales pipeline, revenue by customer report for the trailing 3-6 months is included in these, and then they constantly get updated so that you don't have to put together a new folder for each, essentially, the debt provider. That's one thing that I would recommend, having it ready before applying for debt financing.
And if I could jump in, or if I could add, obviously a clean set of books, depending on what stage you're at. Some lenders are going to ask for audited financial statements. So, there's those details of cash versus accrual basis, and obviously SaaS, you're going to need to be able to report things in a SaaS basis based on teams, because that's when you look at your use of funds, you're providing expectations in terms of how you're going to spend your money on teams and what you're going to get out of it. And then the other big thing is to make sure that that your forecasting story makes sense. So is it defensible? Is there a reason? What are the key pieces that that you're going to use the funds for, and what's your expectations? And so if you demonstrate a hockey stick forecast, that's fine, but there needs to be some pretty clear defensible reasons, the story behind it, that gives everyone a level of comfort that that's actually going to materialize. And probably the last thing that I would say is just make sure that you're asking for the right amount of money, because if you're conservative and you don't ask for enough, then all of a sudden you back yourself into a bit of a corner, and can make things a little bit uncomfortable unnecessarily. So 1 million to 2 million typically is not not a big deal from a funding perspective. It is from an operational standpoint, and also make sure that you're not asking for too much. So if you're asking for funds where and anticipating that you're going to spend it within an unreasonable amount of time, typically most of the funding is related to hiring staff, and we all know that it's pretty challenging to find and keep talent. So so again, it's that reasonableness in terms of, does your story align with the ask and your projections?
Thanks, Michelle. One of the things that we look for as a yardstick at Timia is 12 months of cash post Timia disbursement. So that doesn't mean that Timia is going to provide 12 months of runway, but from the cash that you have in your bank account, from the cash you're going to generate from your customers, from possible equity involved, et cetera, perhaps government grants, you'll have 12 months of runway. And so we're not looking for that hockey stick growth. We're looking for, let's say, 30 to 40% growth a year, and anything above that is great. So if you have a cash flow forecast and a plan that can operate for 12 months, we get very comfortable with that. So you don't need to have these big giant plans to have that hockey stick growth. However, if it happens, that's better for you. Alternatively, if things don't go to plan, you still have extra cash on the balance sheet. So you can still make changes if necessary. You're not going to be put in a very difficult place. And so I think for what you said, being reasonable, being a little bit on the conservative side is a good place to be. And then if things go really well, then that's great. It's great for the entrepreneur.
Yeah, and just to add to that too, going back to Colin's question, which is something that we think about on a daily basis, how are the venture debt markets, tech lending spaces are changing. One thing that I can say that the runway requirements are definitely increasing, and without even the lender requesting it, we do see tons of companies that are leveraging every single debt tool that is available to them just to keep it in the bank account right now, because there are obviously the valuations are coming down and everything that we hear on the news right now. So typically, just like Mark suggested, you would have 12 months of runway, but I have seen companies that are keeping 30 months of runway in their cash just to weather whatever the storm that we may go through, right? So I just want to point that out as well.
That's a great point. One of the companies that we're currently doing business with, I'm just going to talk specifically to one. They are currently going through an acquisition. So they've been with us for some time. They're looking at an acquisition. That acquisition is currently being delayed because of the current markets. And the entrepreneur has come back to us requesting additional cash because they're thinking, well, I'm almost breaking even. I thought this would happen a lot quicker, but let's get some extra cash on the balance sheet, because if this doesn't go through, I need to have that backup plan. We're seeing a lot of that. That's one example, but we're seeing a lot of that generally in the market.
For sure. And then I guess the second question Colin had is a faster path to cash flow positive more critical now than it was before, when there was a stronger presumption of Series A following 10 to 14 months? I would say absolutely. With the caveat that if you are going to forsake growth just to have cash in the bank account, that's also not desirable. I would just point that out, because if the company is growing, if the gross margin is high, not necessarily getting to cash flow positivity, but being able to show that you can scale down operations within 3 to 6 months is what debt providers are looking for, not that you have to be cash flow positive.
Appreciate those insight, guys. And again, to the audience, keep those questions coming. We will dedicate some time at the end to Q&A for anything we don't get to. Before I move off this section, I do want to address the area of products specific to utilization. And I know on the slide here, we're calling out product development, sales, and marketing. I think to some of the points that Mark touched on earlier, ROI and short-term ROI play a key role in the product selection that for funding products. But the area of product development is also really, really important, particularly when businesses are pre-revenue. So I might start with that and open up to the panel. When businesses are looking to finance that product development stage, what sort of products should those businesses be thinking of? And again, open up to Mark or John or Michelle on this.
Sure, I'm happy to go first. I would say that particularly shred lending makes sense for product development because we see two different use cases for companies that we deal with. The advances that they get usually go into the same R&D projects throughout the year instead of waiting until the year-end refund. And what that does essentially inflates the year-end refund even further because you are continuing the same R&D projects that you were investing in to begin with. And this is probably one of the only debt solutions that we would recommend using it for product development because in most cases, you want to see an ROI much faster than that, especially if you are paying lower teens in terms of cost of capital for this type of debt solution. In other cases, I would say 40% of the time, companies are taking this capital and investing in more sales and marketing initiatives that have a lot better predictability in determining what the ROI is going to be for those.
Thanks, John. And just to build on that, on the sales and marketing, when companies at this stage of their life cycle are looking to fund additional marketing and increase marketing spend, what are the products that you're normally seeing in your clients, Michelle and Mark as well?
So when they're looking to spend on marketing, it's as Mark had said. So there's like the clear codes, which are specific for very discrete. They actually fund on sales and marketing spend. That's kind of their whole reason for being. And then the alternative sources of funding, which Timia would provide. So revenue-based, or sorry, debt financing based on ARR, revenue growth is.
So that's, I find, often a point of confusion for some folks out there and some entrepreneurs. Revenue-based financing, there are different products that often use that umbrella term. I wonder if someone might step up and provide a bit of clarity on this.
Yeah, I can jump in here. So there are quite a few products at this stage. So I would call this, let's say, $2 to $5 million a year companies. There's a lot of options, and certain ones will be a stronger fit for each company depending on what space they're in, what they're looking to invest in, et cetera. So traditional revenue-based financing, or RBF, is a percentage on your cash flow. So as your receipts come in, a percentage, let's say somewhere between 4 and 8, possibly even 12%, will be automatically taken off the top and returned to the lender. And there's a lot of companies that do this. You can do like a merchant cash advance. You can do short-term loans, like Michelle commented, with companies like Clearco. And then you can move to more venture debt style loans, something that Timia provides. So these are typically longer term, so 2+ year loans. And they typically have a lower cost capital, but typically they are providing a lot more cash for the business. So getting a debt provider that is interested in your business for 2+ years is much stronger for these longer term initiatives. Maybe not necessarily like a 3 to 6 month, Google ad spend. That's where the alignment strengthens. And so even for us at Timia, like, we're comfortable with product development spend, just as long as there's a little bit spent on that, maybe a little bit on hiring sales marketing teams, and probably OpEx as well.
Yeah, certainly something that we see quite a lot of is founders and high growth stage companies not really being aware of these products. So whilst a lot of people, particularly in Canada, might recognize brands like Clearco and understand the concept of an MCA, the concept of financing future receivables from recurring customers is still kind of a novel one for some people, and actually presents a really good value proposition for a lot of companies that are going through this stage of their journey. Yeah.
Just one thing to add, when taking any sort of capital whether it be friends and family, whether it be VC, whether it be debt, doing the math on cost of capital and understanding your restrictions, covenants, payback periods, early repayment penalties. There's lots to it. And so with on our blog, we do some digging into like VC term sheets and what to consider, but really any capital you're taking, talk to someone like Michelle, talk to an advisor to really understand what it means to take this extra cash.
Yeah. I would love, maybe I'll deprioritize it to the end of the session, but Michelle, I'd love to hear some of the funkiest things you've seen in term sheets. Okay, so I'm going to move on maybe to the next stage of growth that we're going to deal with, and we're calling this growth. So really, we're looking at refining the sales process, building new lead generation sources, focusing on customer retention. And again, to kind of talk through the reporting theme, we're looking at CAC LTV and other metrics that investors and funding providers might pay attention to. So on this point, I think one area that we bring a little bit of value to customers is really looking at the optionality that exists in the marketplace. So I think, engaging with brokers, marketplaces, other lenders out there really adds a bit of value, and other advisors, because businesses, particularly smaller businesses, when they're so focused on their growth, don't pay attention to all of the options that are out there. They might have a relationship with a bank, but again, all of these other financing sources that exist out there in the market that can help them through their growth journey exist, and sometimes it's hard to get visibility over them. Al, I might just bring you in on this stage and just talk to the kind of reporting elements that are important for businesses to be aware of at this stage of the journey when applying for financing.
Yeah, I mean, first off, just if I can kind of add, like at this stage, you have a lot of options in terms of how you want to structure your financing. And so you've got a whole bunch of, you've got equity, you've got debt equity, you've got debt financing, you have all sorts of things. So, so understanding what your end goals are, at least within the next, medium to long term, is really important, because you can get very creative in terms of weaving all of the financing together to get to where you're trying to get to. And then from a reporting standpoint, typically, so this is where you're a mature organization, you're looking for growth, and so you need to make sure that you're managing your growth through your metrics. So it's funny, when we talk about financing and we talk about getting everything prepared to present to a pitch deck for a VC, or preparing forecasting for bankers or such, it's really important that we actually use that information just to drive the business as well, and to really understand things. And so so that process actually can be very clarifying in terms of articulating strategy and understanding where you're at. So I would say at this stage, most important is, you've got your accrual based accounting, you're reporting on your SaaS metrics by teams. And then again, you're looking at your growth. Churn is so important. It's a critical metric because it's known as a leaky bucket. It's one of my favorite metrics, because the reason for churn can be anywhere within the organization. It could be product market fit, could be on the sales side of things, could be client success, all sorts of really interesting operational issues that can be surfaced. So those are probably like the most important metrics to measure on a regular basis. And then you also want to step into, as you get more clients, you want to look at cohort analysis as well, which is really interesting, and just understanding and defining your cohorts in terms of timeframes, geographies, product fit, those types of things. So this is where we get into a lot of analysis. To help guide and provide feedback.
Very cool. And John, I wonder, from a North Star metric point of view, are there any metrics that you traditionally pay very close attention to when it comes to businesses at this stage?
For sure. So I'll probably take off my tax credit lending hat off and put my revenue-based lender hat on for this. And I would say that the key metrics for us in the previous companies that I worked at would be the growth rate in comparison to the gross churn analysis, like Michelle mentioned, because as a venture debt tech lender that did not look at sponsored companies, we were totally fine with companies that were growing at 20-30% year over year, as long as their gross margin was above 75-80%, and their gross churn, if they're a B2B SaaS company, if their gross churn was less than 15%, right? And those are some of the, it's not necessarily one metric. How all of those metrics dance with each other on a financial statement is really how we looked at it. And there is a perfect scenario for those companies. So we have the top line growth, gross margin, gross churn combined with the burn and how much burn is getting reduced on a monthly basis, right? And once you put all of these components together and you start stretching that financial statement into the future, you can see the trend lines. And especially if you have the breakdown by different segments, by different regions, you get the full story of a business, right? And ultimately at that point, we are trying to understand what is being done in the business to be able to address some of these risks and what are the mitigants. And that's how we made the investment decision. But it wasn't necessarily one metric. Again, it was a combination of metrics, but it's essentially listed on here. You have a lot of opinions about net revenue retention, what should be included, what should be excluded. For me, I've always favored the gross churn numbers because I needed to know how many businesses that were acquired in a specific cohort in the past were being lost and what were the reasons for that as well, right? Like you can really get into the granularity of the strength of the sales pipeline when you understand what happened, why a business lost their customer, and what is the likelihood of them losing a customer in the future as well.
Let me just jump in with one last thing here. Great comments, Michelle, John. I'd just add cash flow. And Michelle actually has a lot of insight on this. And a lot of people might think just managing, like looking internally at their business and what their cash flow is for a 12, 24 month and post that, but also look at the product that you're looking for, whatever type of investment you're doing, what is going to be the cash necessary to service that. If it's debt, for example, you might consider, oh, okay, we've landed quite a significant amount of debt, but if you've got a short term of that debt and your principal payments start accelerating, that might put a problem in your growth plan. So I think aligning your cash flow forecasts with the type of debt product you're choosing to use is also very important.
Yeah, it's a great point. And I think at this stage of company's journey, the kind of emergence of traditional lending being an option is super interesting. I'm just going to bring up a question that's come in from Brian, looking to define the operational stage for a B2B SaaS company. And is this a function of minimum ARR, M or or? Invite any response to that?
Yeah, I can jump in there. I mean, there are revenue-based financing lenders such as Lighter Capital that will look at a company as small as 50 to 60K MRR, right? I think most important thing is not definitely that minimum revenue threshold is important, but also having at least 1 year of revenue is important as well, because without having 1 year of revenue, you cannot do any churn analysis. Therefore, you cannot predict how many of the customers that are being onboarded are going to churn in the future. So the minimum revenue, I would say 50, 60K, you can start tapping into some of the fintech lenders, but there needs to be at least 1 year of revenue.
Yeah, and just that options increase exponentially as you get larger. And maybe this is a good segue, because once you're past that 100K MRR, there's probably a handful or a dozen options available to you. Once you get past 5 million, opens up a little bit. And then once you're over 10 million, it's almost endless. I think I know of over 100 lenders that are willing to get debt lenders that are willing to get involved north of 8 or 10 million.
Also at this stage, aside from the proliferation of all these new options that are available to companies that are hitting this level of revenue and this level of growth, I think acquisitions and M&A is also a real characteristic of this stage of companies' journeys. So kind of interested to hear maybe from Mark or Michelle, companies that you've worked with over the past and the approaches they've taken to financing maybe their first acquisition.
Yeah, so traditionally I've seen acquisitions being funded by equity. That seems to be kind of the norm. Yeah, it's and you know what, some traditional banks will provide funding for acquisitions as well. It just depends on, obviously, if you're at the expansion rocket ship stage in terms of, you know, your size of revenue, because it's all about risk, right? Yeah, so some traditional finance banks will provide funding for M&A if you're large enough. If you know, there's a couple other things, you know, if depending on the target M&A and the quality of that acquisition is also another important factor.
Yeah, additionally, what I'll throw in here, when you're considering acquisitions, maybe it's an acquisition that you're not, maybe you don't align this with acquisitions, but Timia also helps founders buy out tired investors or co-founders that just haven't been involved in some time. And so that's kind of a little bit on the previous slide and a little bit on this slide is, again, it comes down to ROI. So if you're looking at postponing a Series A or Series B, et cetera, you could take out a tired investor, or you could acquire a company and grow that revenue, or you could buy out some co-founders that have been around and maybe aren't involved anymore or not as much involved. Maybe they're looking for an exit quicker than you are. And so that's where some debt products can get very attractive, because you can see an exit on the horizon. And debt might be the option for a short term, maybe 2 to 3 years.
Okay. I want to be cognizant of the time that we have left and make sure that we have a good opportunity for people to pitch in questions and give us opportunity to address them as well. So I'm just going to move on to the final slide, which sort of just summarizes some of the points that we've been speaking to. And we did have a question, and this might go back to an earlier stage of the growth journey. We had a question from Rachel. What are some of the options available for a 5 million plus ARR company? And open that one to the panel, because I know we've discussed a couple of options already, but maybe we can delve into that in a bit more detail. John, do you want to?
Sure, yeah, why not? Go ahead. Keeping my revenue-based lender hat on, I would say that revenue-based financing is definitely an option. Venture debt, private venture debt funds, definitely an option. It's just a matter of if there is an equity sponsor for this company or not. But there are a lot of private funds out there that would love to look at a 5 million ARR company, as long as the gross margin is above 70-75%. With path to profitability within 16 months or so, I would say. Another thing that I want to clarify very quickly, revenue-based financing, Mark earlier made a distinguish between revenue-based finance and revenue finance. One is essentially an MRR lending facility, and the other one is a royalty-based. The payments are based on your monthly gross receipts. The ones that on the revenue-based financing, where the payments are based on monthly gross receipts, you also have two other options. One is capped RBF facilities, and the other ones are perpetual. So these two different methods are also available to companies with 5 million ARR, where depending if you go with a capped version or uncapped version, obviously the IRR can be anywhere from 16-17% to 25-30%. And at that point, you are comparing that to an equity without essentially losing the company, diluting the company. But those are some of the available facilities at a 5 million ARR. And I'll maybe let my other colleagues answer on other available ones as well.
Yeah, thanks, John. The other thing I would look at is subordinated or senior lenders that aren't necessarily traditional banks. So these are companies like Bridge Bank, Avid Bank, Level Equity. CIBC is getting very aggressive in the US. They've got a portion of their bank that a specialization that can do that. These type of companies can come in and actually be quite aggressive. 4 months, 5 months, even 6 months worth of debt in the business. And Timia can actually subordinate to that. So you could get 9, 12, even 14 months worth of cash combined with multiple providers. And they're pretty attractive rates, and they don't have a lot of covenants. Sometimes you can get debt that is a bit more attractive with warrants. So if you're comfortable with an equity kicker, there's a lot of options out there.
Thanks, guys. One or two more scenarios here. So going back to the pre-revenue stage, Adi puts in a question here, looking at a new wearable tech company, acquiring the IP from overseas, pre-revenue, funding strategy is probably going to be bootstrapping and fundraising from within his network. What other alternatives are worth considering at this point? Anyone from the panel might have anything to pitch in with here?
Yeah, probably what Adi is suggesting, investors from our personal networks, identifying angels, that's good. Y Combinator has made popular the safe note. So I'm not sure if that's very popular with the group that we're speaking to at the moment, but a convertible note or a safe note might be interesting at that point. And then also, Brian also asked, is it best to offer a debenture and dilutive equity offer? Brian, I think that really depends on what you're willing to offer and if there's appetite from the people you're talking to.
Thanks for that, Mark. So one of the questions we have in here is just about equity sponsorship. So what does that really mean? Are they on the hook in the event of default? My feeling is that yes, they are on the hook if the company goes under.
Yeah. So typically they are. So typically that's the agreement, and that's why traditional financial institutions like that, because because it minimizes the risk, and it also from a process standpoint, it reduces the amount of due diligence that the lender has to do, because they know that the VC has already done a certain amount of diligence, and so they do a very light touch. So that's why traditional institutions like to just rely on an equity sponsor.
Yeah, and some venture debt lenders only work with certain VCs as well. So if you're interested in, let's say, one particular debt provider, they might not work with you just because the VC that you've raised your equity from isn't approved from their firm. So I'd also do the research into that on both sides, whether you're raising equity or you're raising debt.
Yeah, that's a really good point. At one of the startups I worked at, we switched. We were doing a raise, and we switched from an institutionalized VC to a fairly unknown, and then our banking partner needed to go through a couple of extra steps, and get comfortable with the new VC, because we're switching out a known entity with an unknown. So.
One quick note that I wanted to add, since we are talking about the bank facilities as well, some of these debt facilities we talked about, they're not mutually exclusive. There's a way to stack them, and diversifying your capital stack is what we usually call it, but it really is dependent on the founders and the executive team's ability to negotiate with the banker that, hey, I'm going to use this line of credit for my working capital purposes, and thank you very much, but I would like to also have access to MRR lending facility would you please allow Timia or another facility provider to come in? And having that conversation early in the process helps a lot, because I mean, I have seen balance sheets that have essentially 3, 4, you can even layer cap trace above that. There are different providers for different purposes, but I think that's one thing that we didn't discuss much, but they can definitely coexist with each other as long as the founder can negotiate with the senior lender first.
Great point, John.
Yeah, that's something that we actually see quite a lot of on our side. So one of the facilities that we help a lot with is equipment financing, which almost doesn't even get treated as debt. So sometimes they'll have multiple facilities on the equipment side. They'll have a senior lender and a subordinated lender, and that would be a pretty standard debt kind of cap structure. So I am conscious of everybody's time because we're at the top of the hour. If anybody has any further questions and they want to reach out and speak with us, our contact information will be shared after the webinar. So please do reach out and connect with us. And yeah, listen, really appreciate everyone taking the time to join today. Thank you to the panelists, John, Michelle, and Mark, for your insights. I really enjoyed the conversation, and I hope everybody can take away some nuggets of information.
Thank you so much for hosting.
Thanks, Dara. Thanks for having us.